Hey guys, and welcome to our Performing Due Diligence introduction lecture. And in this particular lecture, we're going to focus a little bit more on understanding the business. What is the story? What are the industry dynamics? What are the drivers of that particular business? So essentially, we're going to continue to build on our previous introduction lecture, which was accounting. And now we're going to really try to understand more about the company, the business model. What do they do? What product do they sell? And hopefully give us a better understanding of how we can look at not just the company, but also the entire industry. So taking more of a macro perspective or a global macro point of view. So we start from a top-down approach. And I'm hoping that we're able to accomplish this in this particular lecture. So let's go ahead and dive into what we've prepared for you in the upcoming slides. So what are the purpose and goals for this particular workshop? Well, focus on researching business stories and industry trends. In terms of more specifics, ability to understand and analyze business models and drivers. How do they make money? What product and services do they have? Is it even a viable business model? Does it make sense? Identify trends and industry growth cycles. Are we in a growing economy? Are we at the top of an economic cycle? Are we coming out of a bottoming economic cycle? Are we entering a recession? Right? These are all part of the economic cycle that we as individuals, as financial analysts, or even as investors, we need to understand when we're looking at a company and figuring out at what stage of that cycle we are in. We don't want to get caught like a situation in 08, 09, like the financial housing crisis. Also, in 1999 and 2000, during the dot-com bubble, right? This is why it's important to understand the economic cycle, because we don't want to be caught at the top or at the peak, making investment analysis and buying and taking on new positions when we are at the top of those economic cycles. So that's why it's so important to identify industry trends and industry growth cycles. Lastly, apply industry insights to help us forecast our financial statements model. So a lot of the information or a lot of the steps in performing due diligence is going to really help us determine what the growth drivers are for our businesses in terms of forecasting revenue growth, in terms of forecasting margins, profitability, SG&A, taxes, which ultimately impact the bottom line of a company. So I hope that we're able to target and accomplish all these goals in this particular workshop. And if you have any questions, you can always pause the video, replay it, and you also have access again to Google, which is a great resource to help you understand some of the concepts that I am covering. I hope I do a good enough job in explaining it, and you don't have to go to Google, but hopefully you won't need that source. But if you do, it's right there. It's a great tool. It's a great resource just to get different explanations that might help you better understand a lot of the concepts that we're going to be covering. All right, so let's continue. So show me growth and I'll show you performance. What do I mean by this? Why do stock prices increase? And this is so important and crucial. And I mean, there's going to be so many important concepts that I'm going to throw your way in this module that it would really help if you write it down on a piece of paper, just so that you can internalize it, materialize it individually, because all of this will come up down the road when you jump into the second part of the program and even during the internship. So why do stock prices increase? Very, very important. And actually, from a simplistic standpoint, we can boil it down to three reasons. Number one, revenue growth. It's a company that has a new product, a new service, and it's something that's just new, that is high in demand, and it catches like wildfire, and revenues are just growing, in high double digits, 50, 80%, sometimes triple digits, 100%. Very important. So you need to have high revenue growth. Number two, improve profit margins. That means that per every dollar of revenue that the company generates, after all expenses, how much are they keeping? Are they keeping 10 cents? Are they keeping 20 cents? Are they keeping 30 cents? These are known as profit margins. The higher the profit margins, the more cash flow the company is generate, the more important and appealing that is to investors. And lastly, earnings per share growth. This is the bottom line number, EPS. The higher the number, the better for the stock, because it represents that this business is really growing, especially in an economic environment where you're not seeing high growth like this particular company is experiencing. When all of these three bullet points are in sync and they're all checked, you better believe that these are the main ingredients for explosive growth. What do I mean explosive? I'm talking about stocks that go up by 100, by 200, by 300% in a very short period of time, 6 to 12 months. Let me repeat that. 6 to 12 months is when you usually find stocks, when they meet all of these criteria, when all these boxes are checked, are gonna double, triple, quadruple. Sometimes they'll go up 5x in a very short period of time. Extremely important. And there's plenty of examples out there that you guys can look at to drive this point home. And I've done it on my own. And probably we can set aside a module or a lecture where I'm showing you some of the top performing stocks over the last 4 years that meet all of these criteria and have increased by 4 or 5x. Here's actually an example of that. Now, here's a short break. If you're enjoying our content, don't forget to visit our website, romeromentoring.com, and check out our starter analyst programs, where you'll learn financial modeling, investment analysis, valuation, and develop the skills professional analysts apply on the job each day. In addition to that, you'll have access to our platform and exclusive access to content relating to investing, stock analysis, opinion, and much more. Join our growing analyst community and level up your skills today. Now back to our content. We have Chipotle. From 2006 to 2015, the stock was up 775%, 7x. Why was it up? Think about it. It's actually a good, healthy concept. So in terms of the industry dynamics and the developing trends, was that consumers were becoming more health conscious. What's an alternative to a McDonald's? What's an alternative to a Burger King? Well, it's Chipotle. In addition to that, they were opening up a lot of Chipotle stores across the country, which was essentially increasing revenue growth. Also, their profit margins was high, and their bottom line earnings per share growth was also increasing. All of these boxes were checked, and you can see the huge increase in this particular stock. What was another one? Apple, up 1,400% from 2005 to 2017. Let's examine this. What was the product? Well, when they first came out, they introduced, this is back in 2005. I mean, it's actually a long time ago for myself. I was actually, I believe I was a freshman or a sophomore back in college. And I was actually I had a part-time job at Radio Shack as a sales associate. And I remember people were buying I believe it was the iPods, the music device. That was the first thing that they came out with. People were buying that like hotcakes. They were selling fast, and we couldn't keep up with demand, right? And those were some of the indications that the company had an exciting product or a service that was going to increase revenue on the top line. Number two, profit margins. The profit margins for the company was also accelerating during that time. And of course, the iPad was, if you will, the first introduction of a line of product that was going to introduce with the iPhone, the iMacs, the tablets, and so on and so on. That first product is really what sparked the growth and the whole innovation of Apple products. And lastly, the bottom line, earnings per share growth numbers were also increasing. And you show me the growth, you show me a company that has a new product and a new service in an industry that is perhaps changing consumer behavior, and it's just the only one of its kind. And I'll show you charts like this. I will show you stocks that go up 5x, and in the case of Apple, 15x. It's just amazing. So why am I telling you this? Because these examples occur over and over and over again. This is not rocket science. Remember, I said in the previous accounting lecture that it's all about creating a formula. It's all about having the same system. And once you understand the principles of that system, how it works, you can identify these stocks. You can identify these moves before they happen. Why? Because you have your checkbox list. You understand how to analyze and perform due diligence on the company. And if you really want to take it to a more sophisticated standpoint, you know how to build the model. You know how to do DCF. You know how to perform comparative company analysis. You can even get even more fancier and build an LBO model and an NNA model that would help you determine what is an appropriate valuation for that particular stock and stay in the stock as an owner and ride the wave. So I hope this little example right here drives that point home, because we're going to dive more deeper into what is the process, what are the steps, what is the principles of this unique system. And again, the steps and the questions that you are going to be answering can be applied to any company out there. And this is going to help you tremendously within the program, within our internship, and even outside of the program after you complete it and you graduate. So let's continue. So we're going to tackle our due diligence in two parts. Number one, we're going to explore due diligence in a much more deeper view and understanding. And then number two, we're going to look at Walmart. We're going to gather all public information after performing due diligence, and we're going to create a set of PowerPoint slides that addresses their business model, their financial overview, the competition, their margins, so that you can have a better understanding of how you gather public information and structure it in a way that is client ready in a presentation format. This is the beginning or the fundamental building blocks of learning how to put together information in a PowerPoint slide. So that's going to be the second part of the due diligence introduction lecture. So let's continue here. Performing due diligence. So the art of storytelling. So what does this mean? Well, everything has a story. You as an individual have a story. I myself have a story, and every company has a story. So with that being said, I'll continue reading from the slide here. Everything is a story on Wall Street. Due diligence is the process of gathering information to piece together a company story. Now, to help you better understand or recognize the story of a particular company, they really fall under 5 categories. Number one, is it a fast, high growth story? Number two, is it a slow growth story? Number three, is it a cyclical story? 4, asset play. And 5, is it a turnaround or restructuring story? And we're going to be able to identify what that company's story falls under by simply looking at the financial statements of that particular company. And we're going to use a specific example as we continue along the slide. Now, when we're performing due diligence, what information should we use? Where do we go? Do we have a set of lists? There's so much information out there in the public that we need to be able to organize that information in a concise fashion. So right here on the slide, I've thrown in the most important information that you really need to perform due diligence and determine the story of a company. So number one is the SEC filings, like the 10Ks and the 10Q, and also listening or reading the earnings call transcripts. Number two, reading equity research reports. Number three, last 12 months of press releases, which you can find on the company website. Check for any stock split, acquisitions, or other material changes like changing management. Was the CEO fired? Did they hire a new CEO? Did the CEO retire? Any additional influential members to the board that might have a business plan or have a whole new concept of how the business should be run, right? Because at the end of the day, businesses are run by individuals. So you have to pay close attention to that type of material information. Is there any changes at the top from a management standpoint and also from a board of directors standpoint? Also, investors relations and management presentation. We're going to examine this a little bit more carefully or actually closely once we dive into Walmart. And industry reports, which would help you also understand the size of the industry, how fast is the industry growing, who are the players, market share, developing trends, shift in consumer behavior, regulation. I mean, each and every one of those points that I've mentioned, you should be answering in your own presentations when you're doing due diligence on a particular company. All right, so pay very close attention to these key points. Now, when we're looking at the big picture, when we're looking at the macro of a particular company, we're really talking about the industry. So I've listed a couple of points here that will help you understand that concept a little bit more when we're talking about the big picture. So you want to analyze business cycles and trends. You want to understand, is the economy growing, declining, or is it flat? What is the industry size, the market share, industry growth drivers and trends? Who are the competitors, industry profit margins, capital structure? Determine the state of current business environment. Again, each and every one of these bullet points, you should be writing it down because it can be translated into a question for your companies. So here's an example, right? When we're talking about the third one, this third bullet point here, industry size. If we're talking about, let's say, Netflix, how big is the video content providing industry, right? Is it $100 billion? Is it $300 billion? And if so, what is the market share that Netflix has on that particular industry? Is the industry growing? Is it declining? What are the trends of that particular industry? What about in point number 4? Who are the main competitors? What are the profit margins? Are profit margin for Netflix and the industry expanding? Meaning, are they making more money? Are they keep for every dollar of revenue, do they keep more? Or are margins contracting in that industry? Meaning, is it becoming less profitable? And if that's the case, you're obviously going to see multiple compression. You're going to see stock prices decline because they're going to be reflecting the underlying trend in that particular industry. Also, in the 5th point, determine the state of current business environment. That essentially just means, are we at the top of an economic cycle? Are we at the bottom of a recession? Are we about to move to a higher leg in economic growth? You have to keep in mind or understand where we at in the economic cycle, because that's going to help you figure out what is your price target over the next 6 to 12 months when you're really evaluating a stock. So I hope this slide really drives the point of looking at the bigger picture, the industry size, the economy, more on a global macro perspective when you're looking at an individual company, right? And you can say that these are forces, external forces, that the company cannot control. They can control internal forces like the price on their products, their services, the research and development, the culture, how they execute and implement their strategy. These are things that they can control. But the external macro forces are bigger picture stuff that you need to understand when you're performing due diligence. What about from a operating standpoint, the financial performance of a company, right? When you're looking at the financial performance of a company, this is going to help you figure out part of the story, right? And the financials do paint a picture. The numbers don't lie. So what are the important line items or the important financial matrix numbers that we should be concerning ourselves with? Well, we have revenue growth, EBITDA, EBIT, net income, and earnings per share. These are all related or important to look at the growth of each and every one of these matrix that I've included here. Profit margins like gross profit, EBITDA margins, net income, and EBIT margins. Book value per common stock, cash return on assets, dividend payout, PE ratio, return on asset and equity. On a working capital front, you have accounts receivables, inventory, prepaid assets, and then your current liabilities like accounts payables and accrued liabilities. Financing, capital structure, debt, equity leverage ratios, liquidity, working capital ratios, asset test ratios, interest coverage. This part down here of working capital, this second part, so I'll call the first one number 1, and this table right here, the second part really focuses on the company's ability to generate cash from its operations in an efficient manner where they can deploy that cash to still maintain the business and run it on a day-by-day basis. In other words, if your company is not efficient from a working capital standpoint, that means that that cash is leaving the business faster than what is coming in. And when you get in situations like that, that is where a company needs to go out, borrow money. And if they cannot borrow money, that creates the situation where, or paints the scenario where the company might actually be in financial distress, or they might be on the verge for filing bankruptcy. This is why when you're looking at these working capital numbers, it's important for your business to have a positive working capital number. It also depends on the industry. Not every company or every industry is going to be operating on a positive working capital. Some industries operate on a negative working capital, and that's just the nature of the business model. But you have to make sure that even though your company is operating at a negative working capital, it's at least in line with its competitors. It's not worse, because if those working capital ratios, if they're worse than its competitors, then I'm willing to bet that that company will run into liquidity issues, leading them perhaps to bankruptcy. So it's very important that you double check your company's working capital ratios. If their working capital, their net change in working capital is positive or negative. And again, look at the ratios versus its industry peers, or the industry mean and median averages. In terms of looking at equity research report, what does a research report tells you and why is it important? Well, research report contains certain information. For example, industry coverage reports gets you up to speed with the industry and gives you really a bigger picture. Explanation on the company drivers, contain updated financial estimates, look for a report with full models. And when we're looking at research reports, we're really looking at reports from bulge bracket companies, bulge bracket banks, where the lead research analyst on that particular company really understands the business very well. They understand the drivers, they understand the business model, they have access to the CFO and the CEO of the company, and they can write very detailed reports on what's going on with that business. And they can also explain and provide their own perspective and determine whether the stock is a buy or sell. This skill set, having the ability to put this research report together, it's what you're going to have at the end of this program. You should be able to conduct industry due diligence, company due diligence, build a full-blown financial model, and communicate your opinion on that particular company and provide a recommendation. Is it a buy? Is it a sell? Just like these research reports right here. For example, JP Morgan, this is an overweight, right? You have a price target. Here's Morgan Stanley. They're also had an overweight with a particular price target on Intuitive Surgical. And then they have their models right here. As you progress throughout the program, you're going to develop skills that compound with each module that would allow you to do exactly this level of report and this level of analysis. Okay? So just make sure you hang in there and you complete all necessary modules, all necessary case studies, and even under the internship, all of the assignments, because this is what we're preparing you for. We're preparing you to perform the task of a full-time analyst. And if you could do that on an undergraduate level, you're ahead of the game. I mean, you'll be able to do things that I couldn't do when I was a freshman or a sophomore in your shoes. And here I am with 12 years of experience showing you how to do these things. So pay close attention, and hopefully you can continue to improve. In terms of business cycles and relative stock performance, there is actually, and I'm actually going to pull this up on our screen here, the platform. I am referring to a particular video created by Ray Dalio, who is the founder of Bridgewaters, that really explains how the economy works. He looks at it from a system standpoint, and he tries to identify all of the moving pieces and parts of that system. And that is essentially interest rates. That is also monetary policy, GDP. He also takes into account productivity and unemployment rate. That really determines how fast the economy is going to grow and how fast the economy might decline. When he puts all of that together in this video, it illustrates how the economy really works and gives you a big picture overview of our economy. But now when we're talking about business cycles, I think this graph right here does perhaps a decent job in explaining that with each step or each phase of the economic cycle, certain industries are going to grow and certain industries are going to contract and decline. It's just the nature of the economic cycle. So for example, when we are in the early stages of a bull market, point 8 and 4, so let's see which industries are these. Transportation and financial services usually outperform in the early stages of an economic cycle. At the late stages of an economic cycle, right here at the top, you have 9 and 11, which is energy and precious metals. They begin to outperform. But if these stocks begin to outperform in the late stages of an economic cycle, you better believe that we are probably at the top and we're going to be heading into a recession. Now, there's a lot of reasons why this market cycle within the economy actually works and why these industries are cyclical. It's just the nature of the beast. So, for example, why would energy and precious metals peak at the top of an economic cycle? Well, because when we are growing at 4 to 5% GDP and we have full employment, that means that more people are working. And it also means that more people that are working have what? Have more discretionary spending. And when there's a lot more discretionary spending in the economy, what are people going to do? They're going to buy cars, they're going to buy TVs, they're going to buy homes, they're going to remodel the homes. And what do you think makes up all of these goods and services, all of these products? Steel. You need energy, you need crude oil in order to transport all of the supplies that goes into making a car, all of the raw materials that goes into creating and building a home, and so forth. This is why at the top of an economic cycle, precious metals like copper, gold, silver, palladium, which is used to go into cars, this is why typically these sectors outperform at the peak of an economic cycle because people are really exercising their purchasing power. And, you know, the US is a consumer economy. So the more people that are working, the more demand for goods are going to be. And if there's more demand, it requires a lot more natural resources to develop and manufacture all of these goods. That's why at the top of an economic cycle, these outperform. And then if that's the case, you better believe that we might be entering into a recession. And if that's the case, well, what are the sectors that outperform during a recession? Well, it's telling you right here, 1 and 3. What's number 1? Consumer goods, non-cyclical. And number 3, healthcare, right? Those are typically defensive sectors that portfolio managers park their money and end up buying those stocks when we are at the top of an economic cycle. So I hope this helps you understand the cycle of our economy and what sectors perform. So, you know, you can pause the screen, you can go back and review this. And again, you can even use Google as a great resource to better help you understand this. It's not 100% correct, but oftentimes I will say that 70 to 80% of the time, this flow right here, it's actually correct and it works. I've done this study, I've done this analysis multiple times, and in some cases I make my own investment ideas off of this particular economic cycle, okay? So let's continue. So in terms of putting together an entire industry slide, so let me actually populate some of this information here. Let me go back. So when we're looking at an industry, in this particular case, we're looking at the mattress industry. How would you construct a PowerPoint slide to illustrate all the important information that will get you up to speed with understanding what's happening? So number 1, how big is the industry? Well, the mattress industry in this particular case is $15 billion. How many businesses are there? There's about 355 businesses. This is a highly concentrated market. There's only several major players that make up 60 to 70% of the industry. Who are those major players? Well, here they are. Major mattress manufacturers. You have Sally, Simmons, Sleep Number, etc., Tempur-Pedic. Within these players right here, they control the bulk of the industry. And here we go. I mean, you have Sort International 18%, Select Comfort 14%, Simmons 11%, Tempur-Pedic. I will also say this is probably about 10%. So when you add all of these up, you're really looking at about 50% of the entire market. It's really concentrated with 5 major companies, okay? Also, what is the expected industry growth? You can see here, expected growth from 2016 to 2011 is 1.4%. So this is not a new innovative industry. This is an old, boring, mature industry. And the expected growth numbers of 1.4% highlights that. What about developing trends with this market? Well, or even more additional valuable information. 35.9 million mattresses shipped each year, and this is actually in the US. What is the average lifespan of a mattress? It's about 7 years. $15 billion industry at retail, so we see that up here. And premium beds account for 50% of this $15 billion. And premium beds are considered beds over $1,000. So these unique bullet points right here really helps you paint a picture or paint a story on the entire industry. And this is what I want you to be develop and build a habit around, is providing very detailed information about an industry. Make sure you use numbers to quantify the size or the impact of that industry, right? This is why, for example, if you're an investment banking analyst or an equity research analyst, there is a catch-up period when you're staffed on a new deal or when you're reviewing a new company. There is a steep learning curve. This is exactly what they mean about a steep learning curve in an industry. You have to familiarize yourself with information and educate yourself to get up to the point of the CEO of the company that might have 20 years of industry knowledge. You might be able to understand all of that within a week or 2 week period. It sounds crazy, but having the ability to know where to find the information, know who to talk to, how to interpret that information will just exponentially increase your education of that particular industry almost to the level of a CEO. Okay, and this is what we're trying to do here. And you're going to see that the better and faster you get at this, the much easier it's going to be for you to understand industries and come up with very key specific bullet points on the nature of the product, consumer behavior, who are the main players, and what really drives that particular industry. So I hope this slide touches on the industry overview and how do you paint and put together the information, because this is a type of format that I'm expecting from you when you're doing your investment case studies and also when you're doing your projects under the internship, okay? Now, what about in terms of industry drivers? Well, you have US economic data like GDP, unemployment rate, GDP dollar amount or the dollar value. What's the size of the US economy? I believe at this point it's about 18.5 to 19 trillion. Personal disposable income, median household income, and immigration are all drivers of the mattress industry. Why? Because if you have a strong economy, if you have very low unemployment rate, if you have people working and you have a lot of discretionary income, plus you have an increased growing population because of immigration, that means that you have more people with money that want to buy a new mattresses. Some of them, they actually want to upgrade. And obviously, if you are a new immigrant, you arrive to the state, the first thing you're going to do is you need a place to stay. So you're going to find an apartment and you need to furnish that apartment. So that is a major driver for mattress sales in the US. So when we're looking at the economic environment, this is kind of what I want you guys to put together when you're creating an economic slide. I want to see GDP. I want to see personal disposable income growth. I want to see unemployment rate. And actually, you may even include another key piece of financial data on the economy over here instead of even showing these bullet points. But we're going to get a little bit more into that once we dive into the second part of the program and we begin to do actual live investment cases. So, as mentioned earlier, we were going to look at Walmart. We were going to look at the company profile. How do we represent comparables, the competitions, the profit margins? And then lastly, where do we obtain all this information from? So, as we continue here, here's Walmart. And let me populate it with this information. So this is what a typical profile slide looks like. You have your business description. You have different operating segments within that company. You have revenue breakdown. You have annual EBITDA margins. And also, you may have your sources where you're getting the information. So all the information I collected to put together this slide is really coming from company filings, the 10K, and the company website. And again, we're going to examine the actual 10K of Walmart and the company website just so that you can familiarize yourself with the proper steps of performing due diligence. Here is bottom-up analysis benchmark. In other words, looking at their main competition. And what are we looking at? Well, we're looking at earnings growth. We can see here that Dollar General is one of the competitors, and it has the highest earnings growth. Return on equity. We also have PE multiples, and we also have dividend yields. The following slide represents a bottom-up analysis as well. Here we have EV over EBITDA multiple numbers, total debt over EBITDA, gross margins, and EBIT margins. This just is a different way of illustrating how Walmart stacks up against the competition. Are they more profitable than their peers? Are they trading at a higher multiple? Are they trading at a lower multiple? This is all part of the concept of spreading comps. This is what you're going to learn how to create in module number 2, valuation. So let's continue here just to gain a little bit of time. So in terms of due diligence steps and guidelines, so this is really coming to the conclusion and really giving you a step-by-step process on how to perform due diligence. The first one is company profile. What are we doing in the first step? On the first step, you want to understand the situation, the company description, and industry competition. Step number 2, company life cycle story. This is where you begin to really understand what is their story. Is it a fast or slow growth story? Is it a turnaround or restructuring story? Is it an asset play or a cyclical story? Then number 3, future expectations. This is where now you begin to build the financial model of the business. Number 4, valuation. This is now where you begin to apply more technical work like a DCF analysis, comparable company analysis, to determine if the stock is undervalued, overvalued. What is the catalyst that may take the price higher or lower? And then, of course, provide your price target and potential return based on your recommendation. And the last step, number 5, is assessing risk. What can go wrong with your investment thesis? You need to start asking questions like, what if I'm wrong? What if my buy recommendation is actually incorrect? You need to sanity check each and every one of these steps to make sure that your thesis and your conclusion can stand scrutiny. You should be able to answer tough questions about your investment thesis. And then, of course, talk about management ability to execute, the general economy, competition, and regulation. Some of these are external forces that management cannot control that actually pose as risks to the business. But for the most part, when we're looking about execution, these are things that management can definitely control. So right here, I've laid out 5 steps on how to really perform due diligence, build your story, come up with your recommendation. Is the stock overvalued, undervalued? Build your financial model. And lastly, determine the risk with your recommendation. Okay? So before we wrap this up, let's pull up the SEC filing. So I'm going to change right here screens, and let's pull this up right here. And here we have the SEC.gov website, and you see it right here on the URL address. If we click on company filing and we easily type here Walmart, so let me pull up here my keyboard, WMT for Walmart. We want to search for the 10K because that's the most in-depth report that gives us all piece of information on the company. So I'm just going to do a quick filter, filing type, just going to type 10, enter, and we want the 10K. Here it is. So if I click on the 10K, here is the first item. It's typically the largest size file that has all the information. And here is what a 10K looks like. Now, for the most part, each 10K will have a table of content like this. If you want to learn about the business, just read the first part. This gives you all, let me move actually my frame. Business information, you can read all of this, development of our company, the different segments, what does it mean, super centers, discount stores, neighborhood markets, look how the average square foot or feet of each one of their concepts, how many they have. So this gives you a very detailed information about the company. So this is what I use to obtain all the information. Okay, let me actually scroll up a little bit more. If you want to find the financials of the business, you can just go here to item number 8, financial statement summary. Here is your income statement. Here is your balance sheet. Remember, we talked about balance sheet, income statement on our accounting introduction lecture. Here is the cash flow statement of the company. Okay. And there's one more important area or part of 10K, and that is item number 7, management discussion and analysis. This part right here gives you a very important piece of information on why revenues went up or down. Why did the company margins increase or decrease? Why did they have a restructuring expense, a goodwill charge, an increase in legal expenses? This is where you get a lot of key information that kind of puts into perspective what's really happening with the company. It's in this section, item number 7. So I really touched on the most important parts of a SEC filing, especially the 10K. It's these parts right here. Let me go back up to the top, which is part number 1, the business. Part number 7, management discussion and analysis. And part number 8, because it gives you an overview of all financial statements. Now, let's also pull up here the company website. So let's go to Walmart.com. Walmart, here it is in Google, Walmart.com. And once you access the company's website, every company has an investors relations part that you need to familiarize yourself with. And you typically either find that at the top of the page. Let's see here. If it's not there, it'll be at the bottom of the page, typically on the footer. And where can we find it here? Let's see. Do you guys see it? Digital, Walmart.com, our ads, terms. Okay, so they're making it a little bit more difficult. Let's see here, careers. Advertise with us. Let's see, where is this? Okay, wow. So they're making it difficult for investors to see their business. Okay, so it would be here, our company. So it's not that direct with Walmart. We just have to do a little digging, but I believe it's in our company. So if I click our company, this section right here, now look at the footer, at the header, investors. Here it is. So if I click on investors, this is where you'll find a lot of insightful information about their press releases, their quarterly reports. Right here is press releases on the most recent quarter report. You can even look at the management presentation, which is very important, right? This is where they give you guidance. They tell you about their strategy, all right? So you have to navigate the investors relations part of every company very diligently. You have to spend a considerable amount of time. Here's financial news, view all. And I will say when you're performing due diligence, you want to read at least the last 24 months of press releases. Not saying that you have to read each and every one, but the headline. And you're looking for things like earnings, a new product, an acquisition, changes in management, whether it is the CEO or additions to the board of director. That's what I refer to by material information. And let's change here the format. And let's see here. And here we go. I mean, you can go through this. And the ones that are material press releases, those are the ones that you want to consider and read to get you up to speed with what's really happening with the company. So there you have it, folks. You have the SEC filings, the 10K and 10Q. You have press releases. You have the management presentation. You may also look at industry research reports. You might even do a Google search on the entire wholesale industry market to get more information. But this is, by the most part, where you will find most of the information that you need to create these particular slides that I've put together here. So in closing, due diligence, everything is a story on Wall Street. Due diligence is the process of gathering information and putting together, piecing together the story of a company. Okay, and then what are the important documents that you need when performing due diligence? SEC filings, the 10Ks and the 10Q, research reports. Make sure you read the company. Well, this is 12. I would actually say 24 months. Press releases. Check for any material information like stock splits, acquisitions, change of management, or new addition to management to the board of directors. Investors relations like management presentation, industry reports. You have SEC. You could even use Google to help you with your due diligence process. And lastly, the company website. So there you have it, folks. I think I've explored all of the parts when it comes really to performing due diligence about a company. But at the end of the day, due diligence is all really about what's the story of your business, formulating an opinion, an investment thesis, and then being able to provide your own recommendation, but more importantly, defend your thesis, whether it's a buy or it's a sell. And when you're defending your thesis, you want to make sure that you're accounting for industry size, the product and service that your company is introducing to the market. Is there a product market fit? What are the margins? How fast is it growing? Do you have a capable management team? What is the competition doing? What are the industry margins? What type of economic cycle are we in? Are we expanding? Are we contracting? And on and on and on. So I hope this lecture was insightful. I hope this gets you a little bit closer to really understanding and performing due diligence on companies, because all of this, all the lectures that we're doing, they're going to compound. And I'm getting you ready for module number 1, financial statements modeling, but more importantly, for the second part of the program where we are actually reviewing and analyzing actual companies. So I hope you found this useful, and I'll see you guys in the next lecture. Take care.